Welcome, everyone. My name is Adam Spence, CEO and Director of SVX Canada, and I was hoping to let that song just play its way out, but mindful that we've got a long conversation to take place today and want to make sure there's plenty of time for a bit of an overview and discussion. And again, delighted you're all joining us today for the Market Report webinar. I'm actually joining you from Toronto, Takaranto, which is Treaty 13 territory. It's the traditional lands of the Haudenosaunee, the Huron-Wendat, the Anishinaabe, Mississaugas of the Credit, and many other nations unrecorded and recorded. Very grateful to be able to meet and work on this land, including the opportunity to share time with you today. And just on the next slide, and you can take a look and learn more about it. Definitely recommend you check out a website called Whose Land provides treaties and agreements, territories, communities, and history, all a part of our journey of reconciliation, which very much includes history and learning. So take a look at that website that is included within the chat. In terms of the format, a bit of housekeeping to also kick ourselves off. One, on a disclaimer basis, this is just for information only. So there's no investments that are being discussed, recommended, or advised. If you are thinking about making impact investments, certainly recommend you consult with the right kinds of financial professionals. In terms of the format, we're going to run through. One, we'll do a little bit of an overview of the report, spend about 10 or 15 minutes on that. There'll be an opportunity for you to hear from a great set of panelists on what are the implications of the market, get their sense and perspective. And then there'll be an opportunity for a Q&A at the end. When we think about it, this is a very important, interesting webinar and discussion. I'm sure a lot of folks will have questions. If you do have questions or comments, I ask you to put those in the chat. In addition, if you need technical support, we're here to help you along the way. So put those questions or notes in the chat. We just ask you to stay on mute during the session itself. So when we have the presentation and the panel discussion, we may ask you to come off mute if you have a particular question, but we'll call on you for that. In order to support this particular webinar, we're joined by a great group of colleagues. We have our executive producer, which is Gabby, does a wonderful job of guiding us through and putting these events and activities together. Also joined by those folks that did the very heavy lifting on the report as well. So Jessica and Mazan from SVX, we should have a round of applause for them and throughout for all the work that they've done. And also our advisors and colleagues that put a significant amount of work and effort into this and are joining us today to be able to talk about that report. And so one is Rod Lohan, Executive Director of the Rodman Sustainability Initiative. We're also joined by Basma Majerbi, Finance Professor at Gustafson School of Business and Director of the Impact Investing Hub at the University of Victoria, as well as one of the lead researchers at the Accelerating Community Energy Transformation Initiative at University of Victoria. So again, a big round of applause, a Mobican applause for them for joining us. So that's a bit of background. As we dive in, what are we talking about today? So this Canadian market performance report is Canada's only report on the scope, scale, impact, and financial performance of impact investing products across asset classes. Our first report was released last year, had a primary focus on private opportunities, also balanced funds. We've expanded the scope, and we'll talk a bit more about that. Where this analysis or where the data and research is really grounded is proprietary data. So we collect that information and data. It's provided by the community through the Impact Index. It's our national database of hundreds of available impact investing products for Canadian investors. We've combined that with specialized survey data. We do that on a regular basis to be able to get that from issuers as well as from investors. We get information as well from administrators and also secondary sources. This work is strengthened by those partnerships, those individuals that are around this particular table to talk to you today, including the University of Victoria's Impact Investing Hub and University of Toronto, Rodman Sustainability Initiative, as well as other industry partners who have contributed to data acquisition, validation, and analysis. Our goal here is over time, how can we establish the right kind of benchmarks so we can see greater adoption of impact investments, help with transparency across the sector, support decision-making, provide actionable insights of what can we do with the right kind of data, and provide this as a resource for investors, fund managers, policymakers, and ecosystem builders. So hopefully it represents that kind of anchor, but contributing to what is a very wide and growing range of research in Canada from many different stakeholders that are really building the case for the why you invest in impact and the what as well. What are the different products that are out there? So we're delighted to be a part of that amongst a number of different community members. What are the key findings? So what did we learn from this report and research? So one is impact is a real force in the capital markets. And so assets under management alongside different asset classes are now a bit of $160 billion across public and private markets. We'll talk in a minute about green, social, and sustainability bonds, which represent a large portion of that particular pool. We look at private market growth, it's more modest. And so year over year growth in those particular assets are 1.6%. So something to note within the data. When we think, though, about the number of products that are out there, so who is actually bringing impact investing funds or community bonds and others to market, that's really continuing to grow on a year-over-year basis, particularly over the past 5 years. And there's many reasons for that, which we can talk about today. When we think about the returns, in a general basis, many of these products, about two-thirds, are achieving or targeting market rate or above market rate returns. When we think about those that are looking at below market, that's somewhat decreased. And so I think that's important for us to note. Now, it is within the context of this is often a little bit lagging data when we look at the capital markets going forward. It'll be interesting to see what things look like in 2027. But more products than ever before are targeting or achieving higher rates of return. And we'd see a greater kind of diversity across the spectrum, so a greater standard deviation. But making sure that we're clear here that most of these products are still, on a majority basis, achieving balanced returns. The message here isn't that impact investments are generating significant and outsized financial returns, but we are noticing there are some achievements on the higher return side of things that needs to be noted and identified, and that's particularly within private opportunities. Then we think about impact management and performance. So those organizations that are measuring or managing their impact has really increased. That's been a challenge in the market for many years. Now we see adoption up to 93%. That indicates the progress in adoption. However, there's still fragmentation in terms of the standards and approaches that folks use and our ability to compare the data. We think about benchmarking. We're better now on finances, but we're still finding challenges on benchmarking impact between opportunities. And then when we think about where are folks investing, so it remains concentrated in climate. This includes nature, biodiversity, clean technology, and also real estate, which is inclusive of community real estate and affordable housing, and then agriculture. And so these are the kinds of areas where folks are investing more in. But there is a noticeable rise and increase in those folks that want to place capital in opportunities that drive and advance racial and gender equity, for example. So these are some of the key findings that we would have gathered from the report for this year. And again, you'll be able to see and learn more about it today, as well as in the report, as you see in the chat. We think about, in terms of just moving on to the next slide, we'll talk a little bit about methodology. So we spent a lot of time on making sure we had the right framework for understanding what is in and what's out on a product side of things. And so we utilize the Global Impact Investing Network's general definition of impact investments, which those designed to be able to generate a positive, measurable social and environmental impact alongside a return, having intentionality, using the right kind of evidence and impact data, that they manage impact performance. And ideally, that these are products or intermediaries, organizations that are driving growth in the industry. And then we get that data from these multiple sources. So our impact index database, our survey that we issue on an annual basis, directly as well, information from investors and product administrators. Many of them contribute their information, which was incredibly helpful. And then secondary data sources. So there's a lot of information available on a range of different organizations that are out there. So this is a data set that includes everything from community bonds to any pension fund assets that are dedicated in this particular way, private equity funds, balance funds issued by a number of portfolio managers. So again, across asset classes, a large and hopefully robust set of data, and you see that in what we describe as our double donut graph in a bit more detail. But a strong and robust set of data that's been verified and validated and reviewed by a number of outstanding partners, including our colleagues at the University of Victoria Impact Investing Hub and Basma. So I'll pass it to her, I believe, to walk us through a bit of background on the GSS database on the next slide. I hope and think. Yes.
Okay, thank you so much, Adam. Before I begin, I want to acknowledge with respect the Lekwungen people, including the Songhees and Esquimalt peoples on whose territory the University of Victoria stands. And you see a picture of our beautiful campus behind me here. On the methodology, I think talking about GSS bonds is a really important aspect of this year's report. As Adam mentioned, last year we were focused primarily on data that cover private bond markets. So I think this inclusion is very important. It was deliberate, and it's a recognition that the impact investing market is not just a private market story. So private market remain a very important part of the market. But if we are trying to size the Canadian impact investing market more accurately, we also need to recognize that the significant amount of impact aligned capital is moving through particularly public debt markets. So what we did this year is include the outstanding Canadian dollar denominated GSS bonds that are issued in Canada. And have not been excuse me, matured by December 2025. So this is used as a proxy of asset under management, so we can aggregate with the other data that we have that Adam just explained. You might see a lot of other statistics about green, social, and sustainable bond more generally. The data may look different. Sometimes people look at amounts issued by year or cumulative issues, but many of these will have already been expired, and so we are just focusing on amounts outstanding. So this is really important. As I mentioned, it's not just about like adding another asset class, but the scale is significantly different from previous market sizing efforts. As Adam mentioned earlier, by adding bonds, green, social, and sustainable bonds, we are now reaching $160 billion in asset under management. So this changes really the picture of the market scale and the investment opportunities that are available, and show that impact aligned finance in Canada is not just done in private market. Of course, we know that, but we have a better picture by including this data. So at the same time, we wanted to be really careful and not overstate the market. So in this report, we only include use of proceeds bonds. So these are green, social, and sustainability bonds, which can be both social or green, dedicated to social or green investments. So the proceeds are directly directed to identifiable projects that are actually in the bond frameworks. We did exclude sustainability-linked bonds, and it's not because they're not actually relevant to sustainable finance, but they are not automatically impact investments. And I just want to explain why. The key distinction here is, again, use of proceeds versus performance-linked financing. So sustainability-linked bonds are general purpose financing instruments. They have coupons or financial terms that are linked to the issuer meeting specific KPIs, sustainability KPIs, but the capital itself can still be used for a general corporate purpose. So for a market sizing exercise that is actually focused on impact investing, as defined earlier by Adam in terms of intentionality and so on, I think this distinction is really important. We wanted the boundary to be credible, transparent, and tied to intentional capital allocation, right? At the same time, we also looked at the data to exclude, self-labeled bonds and just emphasize those that are aligned with external review and validation and public reporting and using things like ICMA green bond principles or social bond principles and CBI taxonomy aligned uh, bonds. So with that, I think I'll pass it on to Mizan to go through the other information. And you have some examples on the slides there.
Great. Thank you so much, Basma. So on the next slide here, thank you. So now you've seen this headline of $160 billion total, which was driven largely by the GSS bond market that Basma just walked through. But what I'll now do is kind of pull the curtain a bit back and look at how the private market has really been structured. So one thing to flag quickly is that this 69% disclosure rate that we have among the private market issuers means that we're working with a very strong but not entirely complete picture of the market. And that's consistent with where the market is at and something we want to be transparent about throughout the report. So onto the product types. In the chart on the next slide here. Great. Yeah. So on the outer ring of this chart here, we see the product count, and the inner ring here is the share by AUM, and they both tell kind of different stories. So we see private equity and venture capital is the most common product type, but in terms of AUM, the public debt markets really completely dominate. So if we strip out the GSS bonds and the managed products and look purely at the private market, private equity and venture capital definitely takes the lead with 56% of the AUM and 42% of the product count. And that's a consistent signal we've been seeing across the data. So onto the product terms. So what we see is a shift towards longer investment horizons here. Last year, about half of the products had terms of 3 to 5 years. And this year that's flipped, where we're looking at 53% now being more in the more than 7 years category. And this is mostly a composition effect due to our data set being larger this year and of private equity and venture capital funds almost always running longer than 7 years. So that represents a bigger portion of the growth. And the table on the left here gives you the product by product pattern. So private bonds sit in the 3 to 5 year range, loan funds being a bit more mixed, and private equity and venture capital are long dated. So the takeaway really here is that the Canadian impact products, they do skew more towards patient capital, and it's something that worth keeping in mind as we get into the financial performance. Great. And so you heard that 12.1% growth rate earlier, and this is the chart where you can actually see it. So with the shape of the curve, you can see how the market spent most of the 2008 to 2016 period in a bit of a steady state with slow but consistent growth. And then the acceleration since 2016, it really picked up and further since 2020. And we've seen 10 new products in the last 2 years alone, which is a great sign of a market that's not just growing, but it's really maturing. And for the geographic distribution by headquarters, the Ontario continues to dominate by product count at 55%, followed by BC and by Quebec at 16%. But what's more interesting is that Quebec represents only 16% of the products, but 34% of the private market AUM. And that's with an average product size of $130 million, which is nearly 3 times the amount of Ontario's $51 million average. And this is largely driven by Quebec's labor-sponsored funds and larger institutional vehicles. But still, it's a good representation to show how product count and capital concentration don't necessarily always move together. So that's the product landscape, and I'll pass it over to Rod now to look at what these products are actually returning.
Thanks, Mizan, and thanks to the SVX team, Mizan and Jessica and others who have, done a remarkable job of what is a pretty tricky project. And Basma's incredible work on the bonds piece of the portfolio in particular is amazing. And, here's where's the rubber hits the roads, and the return on these investments is obviously something that interests us all. while folks here are incredibly cautious about providing guidance on how the bond market has been included in this year, that has, I think, what we could all expect to have an obvious effect on the market in terms of the rate of return, in that we're bringing in a bunch of investments that are not seeking necessarily extremely high rates of return, and in fact are providing a risk benefit by allowing us to diversify across a range. So with that said, the market rate of return has been we're calling it narrowed here, but I think we can say it has been affected by that group of investments included in a fairly predictable way. Next slide, please. In terms of the return ranges by asset class, I think there's some really interesting stuff here, and just further to my point that it's having an expected effect by including the bond markets is here in public debt and in other fixed income assets. These are 100% returning a predictable rate of return, and so especially given the scale of them within this set of investments, that's having a marked effect here. If we just focused in on the private equity in particular, then we're having the opportunity for higher returns. But what really strikes me, and I have a personal interest in the real assets part of this universe, is just what a remarkable return those have had. And so particularly for larger institutional type investors, I think that's pointing to an early indication of opportunities here to be considered. Next slide, please. And then performance by asset class. Again, this completely reinforces what we've just been talking about in terms of the returns across the private equity and venture space, do vary wildly, and we would see that in the regular venture capital markets. But the real assets part of this is the one that, again, sticks out to me as being pretty interesting. There is a lower spread, predictably, in many of these other categories, and that's exactly what one would expect. So, considering where you're at and the kinds of investments you're making, I think this provides some really interesting baseline for consideration and analysis of your own. Thank you. And then in terms of the realized returns, again, we're seeing, I think, some fascinating numbers here. Private equity is somewhat predictably outperforming, or has at least the potential to outperform all of these others. But check out those numbers in real assets and in some of the other emerging categories, which I'm sure will get their own breakouts in future years. But private debt and public debt are also of great interest here, and in a more balanced portfolio, in a large portfolio, there's lots of places for folks to see a way to connect to the impact market in a way that's meaningful to them, without necessarily diving in, for example, to the private markets if that's not something that fits their needs. And so with that, over to Jessica. Oh, am I doing this one, Jessica, or over to you? Over to Jessica.
It's up down to me. Thank you a ton, Rod. Again, I'm not going to go through this information in too much detail, just because obviously you have access to reports yourselves, but I'm just wanting to highlight a few things. Again, there's been quite a bit of an increase compared to last year in the proportion of products in climate and real estate. Not a surprise to anyone there, but a real good growth in diversity and inclusion in agriculture. The decrease in the portion focused on energy, and there is a decrease in the portion focused on energy and infrastructure. However, both energy and infrastructure, in terms of AUM, they're ranked number 2 and number 4 in terms of most AUM allocated towards that. So the decrease could be explained by the increase in sample size compared to last year. We did mention it previously, but again, this year we made a bit of a effort to make sure that we're doing data analysis both on product count and AUM this year compared to last year's report, so that it's comparable to other reports, and there's more data there. All right. Next one. Choose for that. So onto the Sustainable Development Goals. Just wanted to quickly mention again, there has been a decrease in the product count for or proportion of product count for products aiming for planet and environment. However, the AUM is still massively targeted towards here. So 47% of AUM is concentrated in planet and environment if you compare that to the product count. So that could explain again the driven growth for economic growth and people and social well-being. It could be driven by smaller funds. Go on to the next one in terms of impact management frameworks. There thankfully has been a decrease in the proportion of products that don't have a framework. And so that could be explained by many of the products from last year finally completing their frameworks, which is really great. There's also an increase in a portion of products using GRI and IRIS Plus, which could also be explained by the increase in private equity funds in the data set this year. But I'm going to pass it over to Basma to give a little bit more insight here.
Trying to unmute, sorry. Thanks, Jessica. Yeah, I think everyone here recognizes the importance of impact measurement and management, particularly in the context of looking at distinguishing impact investing from other sustainable investment strategies. And obviously here, the big challenge for many issuers and investors more generally is which impact frameworks should we use? And often we point to fragmentation in the sector. And as you can see here in the slide, it's kind of like you can see a big range of frameworks and standards that are being used. In my opinion, this is not like we should not read this as this fragmentation as a weakness. I think we need to recognize that fund managers or issuers more generally tend to layer global frameworks with some of their internal methods that reflect specifically the mandate, the sector, or the community context that they operate in. So I think this is useful, but still I think the next challenge is comparability. So if the sector is to scale with credibility, the field needs enough common language to allow benchmarking and comparison between different investment opportunities. We don't just look at the returns, we also look at which options or opportunity maximizes the impact and also improves the impact over time. So while still allowing for some flexibility to capture place-based or mission-specific impact. So I think for me these results are encouraging. We see some positive trends, but at the same time increase in the use of some globally recognized frameworks and standards. I'll pass it back to Jessica or Adam, sorry.
Excellent. Many thanks, Basma. So again, you heard some of the findings from the report. Impact investing is a major force, more private market asset allocation, but modest number of products is growing, target expectations are moderated, return that are balanced, greater adoption of impact, but fragmentation in some of the key sectors and segments, including climate, food, as well as real estate. I think important for us to have reflections, though, from those individuals that are in the market, managing money, working directly with investors and institutions. And so delighted to be able to bring on to the virtual stage, Dan Chacko from Clear Skies Investment, Carl Pellin from Addenda Capital, and Mark Stacey from High Street Asset Management. So a big emoticon welcome and a round of applause for all of you for making time to join us. So that we'd spend 15 minutes or so in conversation with you to be able to get your take on the report. And I think we'll start off maybe with Mark from your side of things. What trends really stand out to you, and what does this really mean for you and the work you're doing?
Yeah, thanks, Adam, and thanks for inviting me to speak today. I think this is a really great report, and Adam, you summarized the key findings, and really there are a number of takeaways. just the report itself. But then, as you said, there are some great takeaways being an asset manager. And so when I step back and think about the report, I'm going to repeat a little bit about what has been covered, but clearly the biggest trend that I see is that impact investment in Canada is becoming a much more serious part of the capital markets conversation. We're up to $160 billion. Obviously, that's impacted by the inclusion of the green social sustainability bonds, $136 billion. But even at $30 billion, you've still got a very large market with very large opportunities. Now, from a high net worth perspective, that tells me a couple of things. First, impact investing continues to grow despite the uncertain backdrop we face in Canada. And impact investments are increasingly connected to fixed income, private markets, real estate, infrastructure, food systems, community finance. It's the diversification of opportunity for high net worth managers that's important. And second, one of the other key takeaways is the fact that AUM, yeah, it's growing modestly at 1.6% per year, but it does show that it's continuing to grow. And I think just as important, if you looked at the compound annual rate growth since 2020, that's 12.1%, that's accelerating from the prior years. So we're seeing a broadening out of capital markets with impact investments. At the same time, you mentioned about the frameworks. To me, that shows a maturing market. The fact that we've got more formal impact frameworks and return expectations are becoming more realistic. Now, what does it mean for high net worth foundations, families, asset managers? This, when you step back and think about it, the opportunity is real, but selection does matter. We've seen a growth in number of products, very encouraging. We've got more choice, but you kind of summarized this as well, Adam. I think the next stage for asset managers and for the impact industry, better measurement, better reporting, more realistic return assumptions, and thoughtful capital deployment. If we can continue to move forward in those areas, it'll be a benefit to impact investing, and that's a role that asset managers can play.
Excellent. Many thanks, Mark. We'll go to Carl. What trends really stood out for you, and what does this mean for you and your business?
So thanks, Adam. Hi, everyone. It's a pleasure to be here today to talk about our point of view. So, well, the first thing for me that I really liked in the report is that you had the inclusion of GSS bonds. So yeah, I feel it gives a better reflection of the breadth of the real impact market, and that's where us at our firm, we have the biggest impact. It highlights I wouldn't say it's been overlooked, but we tend to forget that there's a lot of meaningful impact that public bonds within traditional mandates can actually deliver. So of course, there's a lot of great opportunities that have direct high impact. They're more private. And there's really nice story. But because of the significant size of the public market, we also have to account for that great benefits from them, even if we don't necessarily see it directly on stories every day. And yes, it reflects the fact also that we're seeing more opportunities. A lot more people are coming to us to have investments with them. The sophistication also of the products that you may not see as much in the report, but we do see that. So as it becomes more sophisticated, like Mark was saying a bit more, that the gap between like institutional manager on our side, portfolio managers, there's more opportunities that it can work together. And also with the GSS inclusion is that it shows that all type of investor can pursue financial objectives while still aligning with their impact goals. So everybody, retail investor to institutional, they can all be part of the impact story, which is great to say to everyone that even a small investment through a public bond could have an impact.
Wonderful. Many thanks for sharing, Carl. Let's go to Dan. Again, what were the trends you saw, and what does this mean for you and your business?
Well, first of all, before I jump in, I just want to thank the SVX team, Adam, Jessica, and like the entire broader team. I know I'm missing a few names here, but all of you deserve a lot of credit for this report, because I know this kind of work is not easy. Impact investing is still has evolving definitions, uneven disclosures, and measurement practices that are not fully yet standardized, right? Which is what your report talks about. So first off, hats off to the team. It's a pleasure to be part of this discussion and to support your work in bringing more transparency, consistency, as well as credibility to the entire Canadian impact investing market. So to jump into the question, I definitely resonate with a lot of the things that Carl and Mark said, but I'll give you my own perspective, right? So one of the biggest trends that I have noticed is that impact investing is becoming what I would call your ESG 2.0. ESG basically helped mature the market. Companies now disclose more. We have data providers that are giving much more better coverage, and investors are more comfortable using all the sustainability information. But impact takes that conversation one step further, right? Traditional ESG, traditional sustainability usually asks, how is the company operating? How is it managing all of its risks? And what does disclosures look like? But impact, on the other side, we're asking, what does the company actually do? What is it actually selling? And for every single dollar of revenue, what are the real world effects that it is having on the people or planet in any way, shape, or form? So I think for me, what I have seen is that shift from your traditional ESG sustainability scores and operational disclosures to products, to services, to revenue, to outcomes is what stands out most to me. And how are we going to measure all of this? What frameworks do we use? Which is a lot of the things that you guys mentioned in your report. And especially in our personal work at Clear Skies, we focus mostly on public equities with some exposure to fixed income and private markets. And my personal take is that public equities matter because impact-oriented asset owners also need liquidity, a trend which we are seeing grow more internationally. It's just like butting up in Canada, because not every single impact allocation can sit in your private markets or long lockup structures. So public markets can provide that exposure, that liquidity, and also at scale when you look at it from an impact perspective. But the impact lens, it has to be rigorous, right? So for me, yes, the market is maturing, but I think that the next phase is about credibility. We need better data. We need better sector level reporting. We need comparability across sector level data, but also across portfolios, and better ways to explain impact without oversimplifying it, right? So these are the things that I have noticed and from my experience.
Many thanks for sharing. Lots of work for us to do together, but lots of opportunity and work to build on. I maybe just want to return a little bit to the financial performance question. It comes up a lot. I mean, board presentations, clients, stakeholders, etc. And so one of the findings in the report was the share of products targeting, and this is targeting, not achieving, targeting above market returns had dropped about 20% to 6.5%. But those that still target at market rate has generally remained the same. So about two-thirds would see themselves in that category. And maybe that's a look forward to the market. But I'm interested in your view. We'll go to Carl first in terms of what do you think the potential recalibration of return expectations? How does that show up in the conversations that you're having in terms of the expectations of investors?
Yes, thanks, Adam. So I got to admit that at first I was really surprised by that number, just seeing that number as a headline. But as it's mentioned, it probably reflects the broader sample with the GSS, so the growing data set. But also, I think you have to be careful how you define market returns. So from where I sit as an institutional fixed income manager, investors are clear. I mean, they want market or better market returns versus Canadian Universe Bond Index. So our fixed income mandates, they have to provide the same return as a traditional benchmark, and they expect that active management will bring value added. So there's no discussion about concessionary returns from our investors' point of view. So yes, in the report, it may seem to be a lower return expectation, but I feel it looks more like all asset class. So it's important to look at market and better return versus your specific asset class that you're dealing with, and versus your traditional benchmark that we have. So that's how our clients, investors are looking at it. So yes, they really support positive impact, but there's also that fiduciary duty lens that you have to consider, because whether it's a pension fund that has to meet obligation, whether it's a foundation that want to support their mission, they need that return. So the opportunity is really in building a portfolio. How can you find investments that still deliver strong impact while still meeting return expectation, or maybe you do a bit of trade-off, but the overall portfolio has to meet the financial objectives.
Wonderful. Many thanks. I'm going to do a bit of a segue from finance to kind of impact and impact washing. I'm going to go to Mark. You can also comment and be interested in how it's showing up in your conversations on financial return expectations. But I want to talk a little bit about impact washing, right? So more actors, greater amount of capital that are entering into this impact investing field. Would you say that it's the same? It's getting worse. It's getting better from an impact washing perspective. And as said, feel free also to comment on the return expectation side.
Perfect. Yeah, I will. I'll touch on the greenwashing then. Yeah, I do have a few comments as well, similar to Carl, but I think I can nuance in a bit between institutional and high net worth. There is a slight difference, I think, in the return expectations. So, with respect to greenwashing, yeah, I think in your question, it's really getting better or worse. I'd say that you're actually somewhat seeing it happening both at the same time, and that's because the quality of the market is improving. There's more products. But the risk is increasing because we're seeing more capital, we're seeing more mainstream participants entering the space. So the positive sign that I see from the report is the fact that you're seeing more formal impact framework adoption. That's improving because the products without the impact frameworks has dropped. It's dropped from 22 to 7%. So that's meaningful progress from my perspective. But the finding also suggests that fragmentation persists, and there are comparability issues across products. So that's where greenwashing at risk can happen. So from our perspective and from a high net worth perspective, the existence of a framework is great, but it's not enough. It's really the beginning of the due diligence conversation, not the end of it. And how you get there to differentiate is you have to understand what the impact objective is. Was it intentional from the start? Whether the manager can measure consistently? Is the data? Is it decision useful? And is there accountability if the impact is not achieved? So, I think there's, from a high net worth perspective, again, you've got to spend some time understanding the framework, understanding the potential for greenwashing, where it matters for impact investors, and why it's so important in high net worth space is it's not just the financial risk, it's reputational risk and values-based risk if we have greenwashing. Clients don't want to invest in something that's labeled impact only to find out later that it was vague or incidental when they did that. So I think that the impact washing risk is higher as the market grows, but the fact that more, and Carl mentioned sophisticated players, people are becoming more aware of what ESG versus impact. I think the ability to detect it if asset managers focus on the correct due diligence and the correct questions, that can help sort of vet out the potential for greenwashing and again improve the overall space as well. And then maybe just quickly, I won't take too much time on the financial returns. I thought that was really one of the most important takeaways and findings from the report. to me, it's not a sign of weakness that the returns are, people are bringing return expectations. It's a sign of maturity. Uh, it shouldn't just be a one return category. Obviously you've got different spectrums across the type of products we have. Some are, want to be fully market rate, concessionary. And I think that's the differentiation between institutional and high net worth investors. High net worth investors will consider a lower rate of return because they also see the impact that they're doing. And I think that is really the question for high net worth investors, not just the financial return, the social return. And so the conversation, when you start to have lower return expectations, the conversation returns much just like public equities. It's what the total return is. And the total return is the financial return, but just as important and more importantly for our clients, it's the intended social return. So to me, this is an important evolution of impact investing, to have returns that are not focused on above market returns, and to be market returns or even concessionary. I think that's an important part. And I think there's some great takeaways for our clients and for asset managers.
Wonderful. Many thanks, Mark. So we covered a little bit of the kind of impact and financial return balance. Let's talk practically. We'll go to Dan on this question, and then I think we're going to open up to a larger audience conversation. So all of you do research, due diligence, impact financial. I'd love for you, Dan, just walk us through what does that look like in practice? What questions are you asking? What evidence are you looking for? And where do folks fall short in your view?
This is specifically for the impact washing?
This would be for kind of the work you do from a due diligence perspective. So when you're looking at impact opportunities, what are you looking at?
Yeah, for sure. So this is the question I probably spent a lot of time thinking about. So for me, rigorous impact due diligence is where impact investing either becomes credible or starts to fall apart, right? It cannot just be a score. It cannot just be a framework. And it just can't be like a nice, flashy looking PDF report. It has to be practical. It has to be evidence-based and connected to how the company is actually creating value. So the way we approach it is we start with the theory of change. The questions that we ask is, what is the problem that we're trying to solve? Why does that problem even matter? What solutions actually exist? And what companies are contributing to those solutions? Then we move into the problem, to the companies. We look at credible scientific research. We look at industry level data and everything that the company has disclosed. And we ask ourselves whether the solution is scalable, if it's commercially available, and how differentiated is that from all of its peers. And from there, we screen and then we assess. So we do have like an in-house tool. We've named it the Impact Radar tool, which gives us a peer level relative score at both an SDG goal level as well as a SDG target level score. But all of that is just like the starting point. We go deeper. So what does that even mean? So we look at a company's product and services. We look at their revenue exposure. We look at all of their sustainability disclosures, what their governance look like, what their human rights look like, what their diversity practices look like. We even have your so-called SASB materiality sustainability issues screener. But so what I'm trying to say is, yeah, we do use your traditional SASB or SDG mapping. We use Iris Plus, data where we can, because you can't really apply that for every little thing, because companies need to disclose on those KPIs. We use the IMP framework for the 5 dimensions of impact. But the key point that I'm trying to make is frameworks, they guide the analysis. They do not replace the judgment, right? So the real question that we need to ask ourselves is, what is the impact claim? What evidence is supporting all of this, and how much of the business is actually tied to it? And is the data strong enough to justify your claim? Another thing I would like to say is that we, as a firm, we also look for enablers, especially in the public market side. And what I mean by that is, for example, if we look at an apparel waste industry, the impact may not just be in a clothing brand. It may be that the impact is coming from the company producing the recycled fibers, or like a biodegradable material or textile recycling technology that helps the whole industry reduce waste. And that matters especially in public markets, because many impactful companies, they sit inside the value chain, and they're not always the companies with the most obvious sustainability label. And after that, we move into the monitoring stage, right? So we monitor the theses over time. We hold ourselves accountable. And whenever necessary, we engage with the company one-on-one where necessary, or with the cohort of other investors. And where companies usually fall short is that they stop too early. So yeah, they show their SDG alignment, they show a few output metrics, but they don't really clearly explain the pathway from business activity to impact, right? So in short, what I'm trying to say is good impact due diligence, it starts with the problem. You have to work back to the solution. You have to assess the company. You have to test all of those evidences about the company. And yeah, you have to, just like Mark was saying, you have to monitor over time. You have to hold yourself accountable. And we have to push with engagement to improve those disclosures and those business strategies over time. So to me, is where the credibility comes from, and how good you're doing due diligence. Because just like we have expectations from these companies and these investees to have intentionality, the portfolio manager better have good intentionality with what he's trying to do with their due diligence as well, right?
Absolutely. No, thanks. Thanks for walking through that very comprehensive process. Want to invite Jessica into the conversation. I think we're going to also invite the rest of the group, open things up to the audience. I'm sure there would be 107 vote questions we could ask. But we'll see what kind of questions we can get in from the audience and others. So let me pass to Jessica to facilitate the next phase.
Perfect. Thanks, Adam, and thanks, Dan, Carl, and Mark, for all your insights there. Again, if anyone has any questions, please feel free to put them in a chat or raise your hand if you'd like to unmute and also ask your questions as well. I did see that there's a few questions in the chat. Great one from Liz. Liz, did you want to unmute and ask your question, or I can also read it out for you?
Sure, I can go ahead and read it out. So, in looking at the investment areas by sector, arts and culture isn't anywhere, and we know that there's a new arts and culture finance fund. It's being developed through leadership at Metcalf and Rally Assets. But I'm wondering if anyone on the call today is seeing arts and culture kind of situating itself in any of the other impact areas, because arts and culture is a mechanism, but the impacts are really broad. So just, yeah, curious to hear from folks. Thanks.
Sure. Amazing question there. The arts and culture is actually, it was mentioned in our research gaps in the report, because that was something that we flagged early on. One of the biggest difficulties when we're collecting data is making sure that we have enough of a sample size that's statistically relevant for this. But to answer your second question there, it's almost certainly being reflected in other sectors there. And it's definitely something that, especially as we see more funds and products in this area, especially in the past year. And so we do want to include it in future reports. I don't know, Basma, I'm sure you're eager to answer that as well.
Yeah, exactly, Jessica. What I would add is that in the survey, we tried to align with the impact thematics of the GIN, because these are impact thematics that have been well, developed with the specific metrics and types of businesses that are included in each theme. And so also for comparison purposes between the Canadian market and the global benchmark of the GIN reports. So there was nothing on art and culture, but I think that this is a good point. I think we can add in next year's survey maybe this category as well as a reconciliation specific category in the impact thematics.
Perfect. Thank you, Basma. Anyone else like to add in that? Perfect.
Maybe
Yeah.
just I can add how we see it from our side. So we have different teams that opportunities must fit in. So for us, we haven't seen a lot of on the arts and culture, but we've seen a few. And for us, it would be in a broader team of community development because we see the impacts, positive impacts in the community. So that's where it would fit for us, even if it's not a specific meeting, of course, our criteria that we develop with our sustainable investing teams.
It's very likely as well for those products who submitted via our survey when we were collecting data that they likely clicked something similar in terms of those fields when we were collecting data. So hopefully we can collect that data in the future. Thank you for the excellent question, Liz. MD, did you want to unmute, or I can also read out your question as well?
Hi, thank you so much for this great presentation and an amazing report. I was just wondering, I saw the impact measurement framework slides and in the report. I'm very much particularly interested from a professional academic perspective as well on IMM frameworks. I was just wondering if there are any sector-specific IMM framework usage, like which sectors are using which frameworks. Is there any data like that? Because I personally would like to go deeper into this.
For sure. That's a great point, and we'd like to go deeper in that as well. Over the summer, we'll probably be doing a little bit, or even over the next year, we'll probably be doing a few more deep dives in terms of our data set to build on our reports that we weren't able to include in this quite lengthy report that we released a couple of weeks ago. So that's something that we can keep in mind for some of these deep dives. In terms of, I do want to point out that we had a total sample size of 583 products. And so if we take out the GSS bonds, we have about 380 and so on. And then if we go into the subset for the impact management frameworks, then it only hits around 80 for the sample size. And so that disclosure on that is very low for the rates there. And so if we break down things via sector as well, we'll have to see if we have a large enough sample size for that. So just keeping that in mind, but something we'll keep in mind for future deep dives. Basma, go ahead.
Just to add that in some of those global standards and frameworks, they also have sector specific. So I think when people, for example, select GRI, they have some sector specific frameworks. And also, if you use IRIS, you can actually go deep into a specific sector, specific thematic, specific SDGs. And so I think they're embedded in the kind of like the overall frameworks that are listed in the survey. There's a limit to how much you can put for people to select from, but it may be also reflected in the internally developed frameworks that was a big category in the responses. And so those may be also captured there. But it's a good point. I think that there aren't many sector-specific frameworks that I'm aware of. There's one on ocean, I think, ocean and marine. But others are embedded in other global frameworks that develop sector-specific metrics as well.
I would just like to say a quick point, because name an impact framework out there. I have used it in the last 6 years multiple times, and I've made a lot of mistakes. So if I can make someone else's life easier, what I will say is that there's no single framework that is enough. And you cannot just take a framework and force a company or a portfolio into that rubric. The rubric has to complement the company, the sector, and the actual impact claim, not the other way around. So when you think about it in that way, you'll find the right framework that fits your sector or your company, or what you're trying to basically translate to your clientele.
Wonderful. Well, many thanks. And thanks, Dan, Basma, Rod, Mark, Mazan, Jessica, as well as Carl had to hop off. But a really wonderful discussion. We could have a whole day, probably a week, if not longer, to spend together talking about impact investing generally, and also about the report. But really appreciate all your contributions, your partnership and support in today as well as the lead up. Also, thanks to all of you for joining us for this particular conversation. Again, you can read a copy of the report. There's a lot more in it, including actions and recommendations for systems level change and how we can build the market. But take a look at the report. Also, friendly reminder, we'll be doing a call for products in mid-May for Impact Index collections. A number of upcoming events, including RFSI Canada at the end of May and the Catalyst event. You can grab those tickets online. And again, just really appreciate you making time today to learn more about the report. If you have follow-up questions, feel free to reach out to us. Happy to be able to have a conversation, get your feedback, and determine how we can improve this in the future. So again, thank you so much. Hope you have a wonderful rest of the day, and we'll look forward to our next conversation. Take care.